The reason I pick individual stocks is because I believe that individual stocks can give you a better return on your money than the overall stock market. That you can do better selecting individual stocks than the entire market, and you can beat the market. Hello everyone, I am Colin and this is Harness Money. I hope you are having a wonderful day and that you are crushing the market. If you select the right stocks, you can 2 times, 3 times, or 10 times your money. I have seen this happen in my own portfolio, and I totally believe that anybody can do this. But you have to be smart. You have to use principles to make appropriate choices and choose those stocks that are really going to destroy the market and are really going to increase dramatically over time. So in this video, I have put together all of the principles that I use to select individual stocks that I believe are going to be incredible in the future. So let's get into it. I'm going to go through all of my choices, and then at the very end we're going to put it all together and I'm going to show you how this works for an individual stock. So the very first principle that I would focus on to select stocks is focus on quality over quantity. That may seem counterintuitive. A lot of the financial advice that's out there right now tells you to diversify. There's a huge push for everybody to be invested into ETFs, to put your money into an ETF fund and just let it ride for decades and decades and decades. And that is a good strategy if you want to build long-term wealth, if you want to steadily grow your portfolio over time. Anybody that is a brand new investor into the market, I would recommend that they put money into an ETF fund. This is exactly what I did when I started, was that I selected just a total stock market fund and built up a position in that before I went out and started selecting individual stocks. It's also great if you don't have as much knowledge about the market or about individual stocks as the overall market. You can just put your money in there and set it and forget it and not do anything. But if you are going to select those individual stocks, you really want to focus in on the best and put your money behind those horses. You want to whittle down the entire universe stocks into maybe 1, 2, or just 3 stocks that you truly believe in. If you're under $10,000 in the market, I would only have 2 stocks at the maximum. If you're over 10,000, then that is when I would branch out into 3 stocks, 4 stocks, 5 stocks that you can put your money into. But the more that you can focus, the more that you can zero in on what stocks you believe in, the best chance you have for potential return. Principle number 2. The second principle is that you want to invest in growth stocks. So everybody has a different definition of what is just a traditional stock or a dividend stock or a growth stock. But for me, a growth stock is one that is a little bit younger and that is hungry. Those traditional stocks are big boy stocks, stocks that have reached the mountaintop. I'm thinking of Apple, I'm thinking of Coca-Cola, Walmart, Amazon, the big giant banks. Those are traditional stocks that generally will pay a dividend. Once they hit the peak, once they hit the top, they generally start paying a dividend, and the growth of the share price is slower. The share price is what is going to determine whether or not you 2 times or 3 times your money in the future. So growth stocks to me are a little bit smaller. They're usually underneath the $10 billion mark, but they can be between 10 and 20 or 30, depending on where they start off. A lot of companies are doing an IPO straight into the $15 billion valuation or above. But there's still so many companies that are underneath that valuation that are just younger, that are just starting out, that are really trying to grow their revenue, that are determined to grow that revenue by 20%, 30% year over year. You want to get in the beginning and then ride that wave up to the very top. That is how you are really going to scale your portfolio. So figure out where your top line is, where your cap is. If you don't want to go above 50 billion, then keep your stocks underneath that specific number. because the next principle is the market cap. Market cap will determine how easily or how difficult it will be to double or triple your money over time. If a company is like Tesla, where it's $700 billion in valuation, in market cap right now, it's difficult to really double that amount of money in the next coming years. It's not impossible. There's lots of companies that have proven that it can be done, like Apple, Amazon, Microsoft. It's more difficult for a company like Coca-Cola or a Walmart to double in size, to triple in size at the size that they're already at now. They really would have to diversify their income, which is what Apple has done. Apple has really reached almost the peak of the iPhone market, the physical hardware market. So what did they do? They branched out into other areas of revenue, like an Apple Watch, like these services, like music, like video, all different kinds of services that they could monetize the App Store over time. You want to find companies that are a little bit smaller in market cap. That $2 billion company to $5 billion to $10 billion, it's much easier to go from $10 billion to $100 billion than it is from $100 billion to $1 trillion. That's a much larger lift than going from $5 billion to $10 billion. So really focus in on that market cap, because that is going to be one of the most important numbers that you can look at. To me, that is more important than share price. Share price can really be deceiving. A lot of companies watch that share price go from $30 a share up to $500 a share, and then they do a split. They split out the stock and lower that share price back down. So it looks like you're getting in at a deal when you go in at $30, but it's really just a math shell game. So you want to look at where is that market cap and how much would it take for that market cap to double or triple. The lower that you can get in, the better chance you have of doubling your money. The next piece of advice I have to consistently tell myself, it's difficult to implement this because there's so much going on, and that is to ignore the noise. You are going to have so much information coming at you and flooding into your mind when you begin your stock picking journey, and even along the way. After years and decades, there is going to be so much information that is coming to you, you're going to want to act on it. But it's really important that you stay laser focused on your thesis, on what you believe in. There is so much information coming at us from the news, from family, from friends, just from all kinds of different sources, from Facebook, that it's important to block out that noise, to block any information that isn't helpful or that is going against what you truly believe in. So for me, I had to go through a period where I let go of a lot of friends because they didn't believe where I was going. They didn't have the same vision for my life that I had for myself. So I had to say, you know what? I'm going on my own path. I'm listening to my own mind, my own thoughts, and I'm blocking out all of this different information. And the same is true of the media, of news, of stocks, is that there's going to be so much information flooding to individual investors, flooding from Wall Street. Often these little smaller companies don't have as much noise going on. Big Wall Street hedge fund money has not come into these smaller growth stocks. So you're going to always hear a ton more news about Apple, about Amazon than you are going to about these smaller small cap stocks like Zendesk and Tattooed Chef and Dutch Brothers. They're so much smaller, they just don't have the reach that Apple does, but they still may be making big moves. And the other thing is that often when the mainstream media has captured a company, it's for a specific reason, because Wall Street has decided that they want to invest into that company. If you find the companies that are under the radar, that means not as much Wall Street money has flowed to those businesses. Once the money and the attention floods to a business, that almost to me signals that it's time to get out of that business, because that you can't compete with the hedge funds. An individual investor cannot compete with a venture capital fund or an equity fund that's on Wall Street. So you want to get in before those companies have jumped in and have thrown all their money into it. That way you can let them do the heavy lifting. You can let them drive the Tesla stock from $100 a share up to $700 a share. That is where you want to get in, and then you want to stretch it out. The more that you can be into a stock over time before it gets recognized, the longer you can build out your financial position. I do my form of dollar cost averaging, which is investing every time I get paid. 24 paychecks a year, I take a portion of that and I put it into the market. So I'm always thinking about, what do I want to invest in next? What position do I want to build out next? Now, the last and final principle that I use to invest and make choices into investments is that I have to understand the business to a certain degree. Now, I should caveat this because there is a level of understanding that you have to be an investor into a business, but then you don't have to understand everything to know that something is going to be a winner. I like to just have a baseline and then build that out over time, really dive in and do more research as I'm investing more into a stock. When I make my first investment, is usually just because I either want to watch a stock or because I have something that has triggered me to get to know more about that stock. So, story time. One of my best investments was Dollar General back in the day. I did really well on that stock because during the 2008 crisis, I saw the American economy shifting. I knew that individuals had less money in their pocket to buy goods and services. So I didn't know very much about Dollar General at all. I didn't know exactly how their business model worked, where they got all their products from, how many stores they had, but I saw a macro trend happening in America, that America was going through a tough time in '08, and that consumers would have less money in their pocket to pay for everyday services like groceries and gas and their utilities. So they were going to have to find alternatives to more expensive shopping like Whole Foods and Central Market. They were going to have to spend less on the items that they needed every day. So that's where Dollar General came in. I saw, oh, this company sells low cost goods, $1 or less, or maybe $1 or a little bit more if they're like bundling products. So I figured, you know what? Consumers are going to need this store right here more than they need the fancy Kroger grocery store. So I bet that business was going to expand and really reach into America and just do really well. And that is exactly what happened. They executed really well. They opened a ton more stores. They served rural America versus urban America, but they sold low-cost goods, and consumers saw that and wanted that. They wanted those low-cost goods more than the high-cost goods. So that business really just took off. And they still, even to this day, they are still executing. But that is an example of an instance where I saw something happening, like I understood enough information to know that the trend was going to be big and that this business was going to be big, but I didn't know all of the details. I didn't know exactly their business model and how they were going to get there, but I knew that everything was trending in their favor. And you can still do that today. You can look at the trends, or you can look at a business and say, okay, are they executing? Are they going to be much bigger today? I'm looking at trends like space. I'm looking at electric vehicles, clean energy, all the businesses out there that are serving online consumers, the online marketplace or the cloud. These are all sectors or economies that are going to be much bigger in 10 years or 20 years or 30 years than they are today. So look for those trends and then understand who are the leading players in that industry. So let's bring this all together. What company am I looking at right now that has some of these principles or many of these principles that I can apply? And I really like GoDaddy. I will do an entire video coming up on why I think GoDaddy is going to be a massive growth stock into the future. But there's so many things that I like about this business. Number one, it's in a growing sector or industry, which is the web. It is a software, so it's going to scale easier than it would maybe a brick and mortar business like a Walmart or a Bed Bath & Beyond. GoDaddy, all they have to do is acquire more online customers to grow their revenue and to grow their customer base. I think it's undervalued. Right now it's valued at about $12 billion. And they've been around a little while. They're not the newest kid on the block, but they are just crushing their revenue year after year. They have a much higher revenue than a lot of other technology business, and they're at a lower valuation, which is what I really like. I want to see that revenue consistently growing, even if they're not profitable, even if you don't see the net income growing year after year. I want to see that top line revenue increasingly growing at a rapid pace, at 10%, 20%, 30% a year. That tells me that they are scaling up and that they will eventually reach profitability, because right now they're reinvesting everything they've got back into the business. They don't pay a dividend. They don't do many share buybacks. They're really focusing on growing that revenue and growing their customer base. And I really think that Wall Street has undervalued this, that hedge funds and big money has not poured into this stock yet. These were all the principles that I use to pick individual stocks. I really believe that anybody can pick individual stocks and dramatically increase their portfolio size, their wealth. The whole point of picking stocks is to choose freedom. You are buying freedom. The more money that you can acquire, the more choice and agency that you have over your life. So stay tuned for my upcoming video about GoDaddy, where I break down the numbers and I break down all the reasons that I believe this is going to be a great stock, and I hope everybody has an amazing week. Remember, make good money choices. Till next time.